Stocks trade ranged as Street awaits clarity on the ministerial berths to be awarded to 71 ministers sworn in along with the Prime Minister on Sunday. Utilities, cement and real estate are prominent gainers even as IT drags.
Mahanagar Gas says discussions on getting gas under GST are underway and a rate of 12% is likely. The move is seen by analysts as a positive for the gas value chain.
Zen Technologies and Bharat Dynamics tell CNBC-TV18 they see no slowdown in the order inflow in the defense sector following the poll outcome. In fact, they expect more aggression on indigenization.
Strong US non-farm payrolls data spooks commodity markets with crude, gold, silver, copper and steel bars all sliding lower as expectations of a rate cut gets pushed back.
Prime Minister Narendra Modi and 71 ministers take oath as the NDA government swears for its third straight term. The new cabinet has 30 ministers, including 5 berths for key NDA allies. Portfolio allocation, however, is awaited.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, today is turning out to be a day where we are trading in a range. It's a bit volatile, you'd have to say. So around 173 points in terms of the Nifty range, or 178 points in terms of the Nifty range is what we've seen today. The high was around 23,411 odd and the low has been around 23,233. So let's see, as of now, just about with a positive bias on all of the key indices such as the mid-cap index, which is up around 0.2%, the Bank Nifty, which is trading with a positive bias, along with the Nifty, which is up around 46 odd points as well. Hi, Mangalam.
Hi, Ekta. You know, you got the color right today. It's green. It's at a record high, but consolidating after a big surge that we've seen. What's interesting, however, is that over the weekend, not only did we get good news coming in from, the Prime Minister's oath-taking ceremony, India winning the game against Pakistan as well, but also monsoons hit the city of Mumbai and a lot of other parts of the country, maybe, 2 days ahead of what was expected by the Met Department as well. And that's showing in the kind of stocks which are doing well in the broader markets. We have a lot of these fertilizer, agrochemical sort of stocks which are spiking. Rallis India, for instance, up around 12%. Fact is up around 10%. We're seeing a decent traction in names like Jain Irrigation as well. Of course, all these companies are buzzing around on hopes of good demand this monsoon, good rural recovery, just the way we've seen in a lot of these other consumer names as well. And the other ones which are doing well include the likes of, Raymond, which is up around 6% as we speak. Interglobe Aviation, not particularly bad, with a gain of about 5% as well. And we're speaking about rural recovery, which is the FMCG company that has highest exposure to rural India. It's Dabur. It's up about 1.5% currently at the high point.
Okay, all right. So that's what's taking place in terms of a couple of these stocks in focus. And like you mentioned, the optimism is largely in place for the markets. But nonetheless, let's focus on some stocks now. PI Industries is under pressure as a key customer. QMI has lowered its guidance. Sonal is here with the details on this. Sonal.
Well, they've cut the guidance. Remember, their fiscal year starts from November and ends in October. So that is how we look at the fiscal or the financial year for QMI. Now, remember, they had given a guidance in December, and now in the first half, they've cut it by 9% further, citing issues around inventory destocking and global channel as well in terms of agrochemicals business. Now, remember, PI supplies pyroxosulfone, which is active ingredient for Oxime, which is an important product for QMI. Pyroxosulfone is the largest export product for PI's CSM segment or the export segment, and there have been questions around pyroxosulfone losing its competitive edge or pricing pressure as well. So this has come in as additional or incremental news flow, which is negative for the company as well. Lower guidance is due to global destocking. The company also speaks about how agrochemicals, the sector is facing an issue, and that continues to be the pain point for PI Industries. The management has alluded to these fears in the past, saying that they are expanding their portfolio and there will not be so much dependence on this particular product itself. However, the issues continue.
All right, Sonal, but stay on. There is also a buzz of the gas sector being included under GST. How would that benefit it?
Well, you know, there have been a lot of talks earlier as well, but again, these talks has resurfaced where there could be a possibility of gas coming under GST. In fact, Mahanagar Gas had its analyst meet takeaways where they did indicate that discussions are underway to get natural gas under the GST regime. Comments have been sought by end of June 2024, that is this month itself, on the new central excise bill. Now, remember, right now, the taxation on gas is as under: excise duty at 14.5% plus state VAT plus procurement tax. So what happens in this case is input on the inputs there's GST, but there's no output GST, which does not allow companies to take input tax credit, and it leads to higher costs for them. But the company says now they expect 12% GST rate on gas, and this could benefit stakeholders across the value chain. And this is similar to what brokerages have been saying as well. Citi, in fact, last week wrote that NDA could consider bringing gas under purview of GST, which could benefit the entire value chain. IIFL says that they believe NDA could consider this in the next 12 months itself. And if that does happen, it could further improve sectoral fundamentals. So that is basically the gas value chain. Jefferies has been very specific. They say government is reviving talks to include natural gas under GST, which could lower the gas cost by $0.8 to $0.9 per MMBTU. Andhra Pradesh, Gujarat, Uttar Pradesh and Rajasthan are the 4 largest beneficiaries of VAT on natural gas, because that is where we have the major gas fields. Now, GAIL's consolidated EBITDA could rise by 2%. Assuming it retains the benefit in the LPG segment, Gujarat Gas's competitiveness would improve versus propane by 6%, and CNG companies should see higher volumes or higher margins depending on whether they pass on the price cuts or not. But if it does happen, it will be positive, but we'll have to wait and watch, because previously as well, we have seen such rumors.
Indeed, we have seen such rumors previously as well, but right now, this time around, as always, you know, the expectations are running, and behind those expectations, we have these stocks buzzing around as well. But it's also the start of a new month, which means that we, got the May auto sales data from the Federation of Automobile Dealers Association, FADA as we know it, which suggests that sales in May did see a bit of a decline. Two-wheeler sales too have gone down by about 7%, while CV sales have dipped around 9%. The question is, what now? To discuss more on these numbers, we have Manish Raj-Singhania, who's the president of FADA, joining in. What would you make of the decline that we saw in the month of May? Was it because of election-related uncertainty, lack of launches, and maybe people are going to, pick up their purchases in the month of June and beyond that? What are your thoughts here?
No, I would not really rather say it's a decline. Actually, on a month-on-month basis, if we compare, it's a decline definitely. But what we could see in the month of May was, in the month of April, we had this Navratra, as well as, a lot of auspicious days for marriage that led to eventual higher retails. But if you compare on a YOY basis, the auto industry has grown by overall 2.61%. And though PV segment is slightly below by 1%, but that's a very minuscule number. And definitely, yes, in the month of May, the heat wave, the political scenario in India, the elections, they have definitely diminished the retails, especially the heat wave. We did a survey amongst our members, and almost there was a drop of 18% in walk-ins in the showroom. And walk-ins, as we know, they have the highest conversion to retail. So yes, but we were able to compensate that. Dealers were able to compensate that with test drives at the home premises or the office of the customers and all that. A lot of customer-related activities we could execute and come up with a decent number in the month of May. And June, yes, we are cautiously optimistic about June because what the monsoon, the prediction that we are getting is above normal. And above normal means that there might be also some flooding also in the region. If that doesn't happen, then the retails would be decent. But if flooding happens, that definitely hampers overall sentiment and the retails of the market. So let's see how it comes, but we are cautiously optimistic about the month of June.
Okay, you're cautiously optimistic about the month of June, Mr. Singhania. What does that mean in terms of numbers? If you have to talk about numbers and, when you talk about the passenger vehicles, are you expecting a good single-digit, mid-single-digit growth on a year-on-year basis when it comes to June? Can you give us a sense in terms of specific numbers that you're expecting on the retail end as a whole?
So yes, expectation is on only on single-digit growth, and that too would be led by majorly SUVs. Now SUVs are totally dominating almost 55 to 50%, 55%, 55 to 60% of the share in PV market, and lack of new launches in the month of June, because most of the OEMs are targeting launches in the just before the festive, that is August around. So lack of new launches, we have to manage with the existing models available with us, and with an ever increasing pressure on inventory. I mean, dealers will be pushing stocks to the customers, and we really need what we really need for a good June is we need good handsome scheme from the OEMs, as well as dealers will also be shelling out something definitely there to make the whole month on a positive note, end the whole month in a positive note. Yes, definitely on a single digit.
There are hopes that there would be rural recovery and rural demand is likely to pick up, even as monsoon predictions have been on the normal side. Inflation has been tame for the last couple of months as well, for the last many months. Now, are you seeing signs of that on ground?
Yeah, definitely. I think since last September, October, we have seen a steady recovery of the rural market. Rural market was the most stressed post-COVID due to job losses and revenue losses and all that, and it took time to recover. But eventually, with good crop, good support price from the government, good spend in the rural segment, now we are seeing shoots of recovery there, and continuously rural market has been delivering now. And with the expectation of good monsoon, and with the ever increasing minimum support price and good quantity and good quantum of crop, we'll definitely see a good rural retails happening in coming months. We in India, we are very sentimented oriented, and a good monsoon would definitely increase the overall sentiments of the market, will turn out to be positive. That is the expectation. And if it really delivers that way, we'll definitely have a good crop, and we can see a better rural market and better rural retails also.
Okay, all right, Mr. Singhania, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of that perspective. That's the word coming in from FADA. They are cautiously optimistic going into the month of June. They did see an 18% drop in terms of walk-ins this time. That is because of the weather-related issues, so maybe that would probably iron out. We'll take a short break, but up next, we'll be talking to the management of Superbit Engineering on their new acquisition of a German light-duty cable maker. Stay tuned. Welcome back. Well, just about consolidating with a little bit of a positive bias at this point in time. Looks a bit tentative for the markets, just about high by around 30 odd points. Let's see whether that sustains or not. But in the meantime, let's in fact focus on Superbit Engineering. They have made a new acquisition in Germany of a light duty cable maker. And this is out of insolvency proceedings in Germany. We have Mr. Kumar Rai, who is the founder and chairman of the company, who's joining in to discuss more on this particular acquisition. Mr. Rai, if you could just start by giving us a sense about this company, SCS. You're buying it out of insolvency proceedings in Germany. It has an enterprise value of around 13 million euros. Give us a background in terms of what this company is bringing to the table. If it's in insolvency proceedings, what is the kind of valuation that you bought the company at? Is it a distressed sale? What are the revenues as well as the margins and the profitability of this particular company that you're buying?
Good afternoon, and thank you for having me on your channel. Just to give a background, Stahl Smith Cable Systems, SCS as we call, is a group of companies headquartered in Germany, but having plants in China, Morocco, Poland till recently, as well as some amount of production in Canada. It's a 100-year-old company. They're one of the leading light-duty cable makers in Europe. What they have done, originally they were all making these cables out of Germany, They decided to move to, Hungary to bring the cost down. Then again, they moved to Poland to bring the cost down more. And then as the pressure from customers increased to compete with, competitors like us or from China, they decided to move to Morocco. In the process of moving multiple moves of main operating plant, they got into cash flow problems. And that's why the German company, the parent, went into insolvency due to cash flow issues. The plants are in great working conditions. Actually, Morocco plant is a brand new plant. Plants in China is very good. So operationally, they were a good company, but cash flows were the problem. And hence, they had to go into an insolvency proceedings in Germany. And through the negotiation with the insolvency administrator in Germany, we were able to acquire this facility, acquire these assets and companies. So that's the way the whole thing happened. SCS is a light-duty cable maker for most of the leading European as well as US customers. Customers like BMW, Audi, Daimler are the big customers on a tier one, whether it is Magna, Faurecia, Lear, Vita, Drama, they're all their customers. So they have a marquee customer base and a very good, well-accepted product. So I think that made us attractive to us. What really is attractive for us is that through this process, now that there is a Morocco plant, we are able to offer our customers both onshoring opportunities if they want onshore, nearshoring like Morocco is close to Europe, and of course low-cost base if they want either from India or from China. So this makes our supply chain footprint perfect for our customers for a long-term value creation for both customers and us.
Just looking at two things then. First is that the enterprise value of this is around 13.5 million euros. And secondly, you said that this will add around 50 million euros to your overall revenue. So the first point is, how much will you be paying for acquiring this? What would be the increase in debt because of this? And when do you pare that debt down? And second part is, by when do you reach that 50 million euros in revenues?
The revenue run rate today is at 50 million euros for the group. So I expect that to be there intact when we start operating this ourselves. In terms of the enterprise value, you are right, 13.5 million. There are certain debts that is there which will be reduced from the enterprise value after negotiation. The insolvency administrator will be negotiating with the creditors and bringing this down. So the equity value will be lower than that. So the way we look at it is that over a period of time, because it's a two-tranche closure, first we are closing the European side, including Morocco. And on the second side, we are expecting to close both Canada and China. It's going to be a few months before we do it. That is the time we'll get a correct picture. In terms of the debt, we are not planning to take any new debt. As you know, we have got nearly 500 crores or 450 crores of cash in our balance sheet, and the requirement is much, much smaller. So we are not taking any debt, and there'll be no additional leveraging happening at all in this transaction.
Okay. You had an FY25 guidance of double-digit growth and margins. Is that correct for the company?
Yes, that is correct.
Does that change now because of this acquisition? Is there any kind of dilution to this guidance because of, say, integration process, because of, say, their operating leverage that you have to bring on?
What we have guided is for our current existing operations, not for the new acquisition. New acquisition will take another year or so for us to consolidate and do a necessary, streamlining of operations. So when we gave the guidance, it was prior to this thing, and this would be separately also been disclosed in our quarterly numbers as to how they are doing. Over a period of 1 year, I think it will be fully integrated into Superbit.
All right, so we'll talk about that in a year once it is fully integrated. Just a word before we let you go. Your margins for LDC are in mid-single digits. With all the synergies and cost synergies that you bring with this acquisition, will the margins be higher than that, or will they still be in the mid-single digit mark itself?
The acquisition this one brings is, as I said, the nearshoring, onshoring, and low-cost manufacturing base, a better consolidation of vendor base, and that means at a supplier end. that gives us a leverage to discuss value for money proposals with our customers. So we strengthen ourselves by this consolidation. That is the first and most important part. In terms of the margin, I think, as you rightly said, SCD, that the controls division, is at a mid-single digit thing. We have given a guidance that will improve by itself this year, whereas this will bring additional, tailwind to us over, I think, 1 to 2 years' time.
Okay, an additional tailwind over 1 to 2 years. That's the guidance coming in. Thanks, Mr. Rai, for joining in and giving us that perspective. That Superjit, that stock is up around 30% in the past 6 months odd. Made an acquisition. Let's see. The integration is probably going to take a year from now on. They're sticking to their guidance of double-digit growth in FY25. We'll take a short break, but up next we'll be discussing technicals. Sachidanand Udekar of Trade Bulls will join in. Stay tuned.
Welcome back. A couple of stocks doing well. United Breweries has hit a record high in trade today as we speak. A big mover, and has been a big mover ever since the election results that have come by the street, hoping for some clarity on regulations in this space itself. Meanwhile, for the markets, we're doing okay. For the frontline indices, a mild tinge of green, back to regular programming after all the events of last week have been done. But for now, today's high on the Nifty of 23,412 is something that we will have to keep an eye out on, because if we're going to consolidate, then maybe this is a level that we'll have to watch out for on the way up. And also the key drag today has been the Nifty IT, and that perhaps on account of news coming in over the weekend from the US of higher than expected job additions. So no respite coming in from a rate cut front, and that has its bearing on the IT pack after a good week that it had last week. The third thing that we have to look at is the Nifty Bank sustaining above that 50,000 mark. Because that is something that it has been crossing a couple of times all through last week and even today, but it's not sustaining above that. For the Nifty, active call options are 23,500 and active put options are 23,200. Both of them together telling you that maybe the street is positioning itself for a range of around 23,000 at the lower end to about 23,500 at the upper end itself. Stocks which are seeing long positions being added, Ramco Cements and Mahanagar Gas. And finally, just keeping an eye out on India Cements. All the cement stocks are doing well today, but India Cements may enter F&O ban because of the open interest activity out there.
Okay, all right. That's on the F&O space. Thanks, Mangalam, for that. Suchitanand Utikar joins in to discuss the technicals now. Suchitanand, thanks very much for taking the time out. It's a bit of a volatile day. We have the Sensex, which has now slipped into the red. How would you approach today's trading session? What would be the key specific stocks to play this market?
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly markets are oscillating within a tight range of 23,400 to 23,200. And if you look at the data, there is multiple evidence that Nifty has a good amount of support near to that 23,200 mark. So even if we see a decline, I think that decline should be bought in unless we don't see Nifty closing below the 23,170 zone from here on. The trajectory for the trend remains on the bullish side. So we are anticipating that eventually we may see a further expansion of this particular move, and even from a trading perspective, markets could scale towards 23,560. So I think the buy on decline strategy should be continued. When it comes to Nifty Bank, the immediate range is around 49,500 to 50,560. Even here, I think it is sustaining well above that 50,000 mark. So the probability is high that we may see banking again contributing in the second half, and probably we may see a swing towards 50,560. So overall, I think markets are stable. They are just consolidating before the event announcement. And if you look at the price action, it is giving us that confidence that we may see a further, legs on the upside.
Right, and individual stocks?
Mangalam, the focus is now on some of the chemical fertilizer space. For a very long time, we have seen SRF oscillating within the band of around 2,000 to 2,700. So what we have already observed is that there has been a very good shift in this particular band, and there's a good sign of fresh support built up somewhere close to around 2,300 zone. Now, if you look at the weekly formation, we have a bullish hammer formation on its weekly scale last week, and the daily RSI has started trending comfortably above that 50 mark. even its 5 and 20 exponential moving averages have given a positive crossover. So that's why we are anticipating that SRF may again move back to that 2700 zone. So from a trading perspective, we have a price target of around 2500 on the higher side. The stop loss can be placed somewhere close to around 2310 from here on a weekly closing basis, and fresh long positions can be added. Our disclosure that would be that we have also recommended this trading position to our clients. The other stock on our radar has been Chambal Fertilizer. Now, if you look at the weekly structure, the stock has been comfortably trending above its 5-week exponential moving average for almost 11 weeks now. On the weekly chart, it looks like a classic bullish flag formation, which is again a continuation of a trend signal. So we are anticipating that this particular move may extend eventually towards 475. But from a trading perspective, we may see an immediate swing towards 440. And that's why we are recommending building long positions in Chambal Fertilizer. And one can keep a stop loss somewhere close to around 410.
Okay, all right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and giving us all of those technical calls for the markets, like we mentioned, just about consolidating at this point in time. The advance decline ratio a little bit on the advancing side. So let's see whether that sustains. Over 2,700 stocks advancing, 1,286 stocks declining on the Bombay Stock Exchange. Quite a wide gap. Let's see. Seems as though it could be a day where it continues to be this way. We'll take a short break, but up next we'll be talking to a KEC International to discuss their new orders backed by the company. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Bottom of your screen, important flashes coming in as the street awaits clarity on who gets what. Subramaniam Jaishankar, S. Jaishankar, as we know him, likely to retain the Ministry of External Affairs position. So that's news that has come in from our correspondents. We'll try and get more details on this one, apart from all the other that we're awaiting right now as well. And as we do that, let's also focus on some individual names. KEC International is a stock on our radar. The company has secured orders worth nearly 1,000 crores, a little over 1,050 crores. And the order intake in this year so far has crossed 3,000 crores. This year, as in this financial year. Vimal Kejriwal, who is the MD CEO, joins in now. Thanks a lot, Mr. Kejriwal, for joining in. Always a pleasure speaking with you. Remember the last conversation we had, you had fallen short of the 20,000 crore order inflow guidance for FY24. And you upped that by saying that this year, FY25, you'll get 25,000 crores. We're not even done with the first half of the first quarter, and you've done 3,000 crores already. So just wanted to know if 25,000 crores is still the target, or you'll do better than that?
I think we'll still stick to 25,000 as of now. 3,000 is orders which we have got spread across civil, railways, transmission. We still have a large 8,000 crore L1 with us. And these are mostly orders which are, which will happen now that the elections are over. Many of them are awaiting approvals and announcements. So we are, I think, comfortable with 25,000. Do we want to up it? I think it's a little bit early for that.
Okay. And you're sticking to that guidance of around 15% revenue growth in FY25. Is there any upside to this also?
Difficult to say today. I think it's, again, I'll say a little bit early. Let's see how the ground realities shape up. How do the supply chain issues, get resolved? Supply chain issues get resolved. We'll see if we can do more. But otherwise, I think it's a fair number which we have given of 15% increase.
Just wanted to understand that what is taking place in the railway business, because you all did have some challenges there when it came to execution delays, some kind of supply chain constraints. Are you expecting that to probably iron out in FY25? What's the on-ground situation there and your guidance on the segment?
Ekta, what is happening is that most of our old projects, as we call legacy, should now be getting over slowly one by one. So that part will get over. We have started securing orders. In fact, if you look at the orders announcement which we made, 1,061 crores, that's almost 40% of railway orders. One is for conversion, gauge conversion, and one is for power supply to metros. We do expect that with the new ministry coming in, and with a little less focus on political gains, I think we'll see a lot more spend happening on infrastructure, and also focus on completing the infrastructure project, which should help us in sort of clearing up the issues which are stopping the execution. So we do expect that railways should start turning around this year.
Railway turns around this year. Also, the SAE business, which turned around last year by being a bit positive for 4 quarters in a row. You expect that momentum to continue. With all of that happening, would you, hold on to that 7.5 to 8.5% sort of guidance? Would you believe that it will be closer to 8% this year in margins?
So Bangla SAE was PBT positive all 4 quarters last year. And
Yes.
they have an L1 plus order book of almost 3,000 crores. They are well placed. We had a very large auction in Brazil this March. And we are very well placed with some of the developers. So I think SAE should do well. I think our guidance right now is at 7.5%. And I think I'll come back to what Ekta was talking about, whether you want to stick to 15% or not. I think both of them are tied together. If you are able to push more execution on the newer orders which are coming at a better margin, then obviously there could be an upside. But I think as I said, I'll wait for some time to comment on that.
What is the downside risk to this guidance? What are you probably most concerned about going into FY25, which could be a headwind for you all?
So downside risk, I think, continues on the geopolitical side. Although we have factored all the Red Seas, etc., into this. Most of our metal exposures are hedged. I think the only piece which is unhedged for us remains steel, which is not very easily hedgeable. So if suddenly, let's say, the steel price shoots up or something like that else happens. Otherwise, I think this year we are pretty comfortable with our numbers, both in terms of revenue growth as well as margin growth. I don't see, honestly, any big risk for these numbers.
What's your L1 position right now? I mean, the last time we spoke, it was 5,000 crores, of which you've got 3,000 crore worth orders coming in already. What does it stand at now?
So you're talking about the L1 position. We are at 8,000
Yes.
crores now.
8,000 crores.
And if you could, we are at 8,000 after this 3,000. Okay.
Right. So, and what's the breakup of these orders that you have, or rather L1 positions that you have right now?
So they are all in the transmission T&D sector. Everything. I think roughly half of it is in India, or slightly less than half of it in India. The rest is international.
Okay. In terms of the international segment, Saudi Arabia, UAE, USA, which would probably be the geography that you're expecting the highest growth from? Because you seem to be quite, bullish on this international T&D prospect. So within the geography, which one do you think you're probably going to bag the most orders from, which you're bullish on?
So it would be between Saudi and UAE. I don't know which one will get more orders, but between the two, I think we should get a lot of orders. US, there's a huge market, but for us, it's a supply market. So it's constrained by what I can supply to them. Otherwise, I can take more orders in US, but I don't think I'll be able to do too much more in US.
Right. And just before we let you go, you did give us a breakup of what your L1 position is right now, all of them nearly T&D. Of this 25,000 crores orders that you are expecting in this year, what would the breakup be? What comes from what segment and then materializes into revenue? So the mix?
So broadly, 50% of this, or maybe slightly more than that, will come in from T&D. So 12,000, 13,000 crores would come from T&D. Another 6,000-7,000 would come from civil. And the balance would be split between railways, cables, and renewables.
Okay. All right, so we're going to leave it on that note. Thanks very much for joining in and talking to us. And I'm sure we'll touch base with you to get a sense in terms of how the year is progressing and whether you're sticking to that guidance or not. Thanks very much for joining in. That's KEC. The stock is doing well today, up around 5.5%. We'll take a short break. On the other side, we'll focus on some more stocks which are buzzing today. Stay tuned. Welcome back. Well, let's talk about some more stocks in focus. Suzlon is down in trade today as the company's independent director has resigned, as well as due to some brokerage commentaries coming through. Vamakshi is here to give us all of the details on Suzlon and the reason for its sluggishness today. Vamakshi.
Well, absolutely. Suzlon is reeling under pressure today after the company announced that its independent director, Mr. Marc Desailly, has resigned with effect from June 8, 2024. Now, keep in mind that he was associated with the company since April 2012 and his term was expected to end in September 2024. But the reason that he has given for this resignation is as follows. He says that corporate governance standards that were applied did not meet his own expectations, including situations where communications lacked his expectation of openness and transparency. Now, in the con call, however, the management clarified that the issues that were raised were soft in nature and were process-oriented and were to be implemented in due course. They also reiterated that all legal and financial disclosures have been fully complied with as per regulations, and they also said that none of the suggestions revolved around financial or operational irregularities or non-compliance with the law. So this is a very important point made by the management, and in fact we had a brokerage note that came in from Nuvama. They said that the company is turning around its financial position and operational ramp up is expected to come through in FY25. The management is also looking to address the needs of the business, and therefore they intend to implement best in class suggestions in due course. So overall they've kept their buy rating unchanged. They've kept their target price, which was at 53, unchanged largely, but despite the commentary that came through from the management, the stock is reeling under pressure on the back of this announcement.
Take that point. The stock has been a big mover on the way up as well. Vamakshi, take your point on these developments out there. We'll of course keep a close eye on how that pans out. That's about today. But if you take a longer term chart, you'd see that it's been a big mover from lows of sub 10 rupees. I remember 18 months ago, all the way up to 47 rupees where it is right now. But monsoons are here, and that also means that the summer season has come to an end. It was a scorching one at that. So good time to get in a roundup of what consumer durable makers did in this summer. 3 years of subdued demand, remember. So the industry has seen a record growth for this season. Good brands doing a lot better. We have Shilpa Ranipeta joining in with more exclusive details here. Shilpa.
Well, it's been a bumper summer for consumer durable makers. Now, remember, like you said, 3 years of decline in sales they've seen, whether it was summer or festive seasons, where they see bulk of their sales coming in from. Now, this summer, the white goods as an industry, it saw record growth of about 25% in the March to May, which is the summer period of this year. And this was on the back of a severe heat wave that we saw across the country. Now, AC segment, for instance, grew between 25 to 30%. And the Consumer Electronics and Appliance Manufacturers Association expects that 13.5 million units of ACs will be sold in 2024, and this is against about 11 million that were sold last year. Now, refrigerator segment also saw about a 20% growth. Now, remember, this growth comes on the back of last year, where there was a decline of nearly 25 to 30% because of unseasonal rains as well. And this year, it's not just the premium, but the mass segment also has bounced back after several quarters of being seeing a decline. And in fact, the unprecedented growth has also led to supply constraints. Some brands have been struggling to meet with the demand, and as a result have had to ramp up production. And this against the situation last year, where some brands had to cut production because they were not able to meet the demand. Now, this is at an overall industry level. If you look at some of the brands that did exceptionally well, Godrej Appliances, for instance, says that its entire cooling appliance segment grew by 60%, and ACs grew about 150% this summer season over last year. Refrigerators grew about 40%. The air cooler segment saw 2x growth as well, and they also had shortages in certain SKUs and models due to unprecedented demand. If you look at Vijay Sales, which is a retailer, and it sees demand from across, it sells across brands. They saw 60% growth for ACs, about a 60 to 70% growth for air coolers, and refrigerators grew about 20%. And they say that the consumer durable industry this year could see a higher double-digit growth compared to last year. Blue Star also, room AC, saw about nearly 70% growth in April, about 60% in May, and it expects this segment to grow about 50 to 60% in the first quarter of FY21. But it did flag that there was some raw material shortages that it saw in April amid the unprecedented demand as as well. Symphony, the company also said that it saw robust demand across segments and across geographies, especially for its household air coolers, tower fans, commercial air coolers, and this was across geographies. Exceptionally good demand is what the company has said. But it's not all good news. Even though the demand is back, thanks to rising temperatures, the raw material prices have started inching up again, and this could mean price hikes. Now, we are given to understand that brands are likely to hike prices of appliances by 2 to 3% in the second quarter of this fiscal, and this is because of rising prices of raw materials like copper, aluminium, which have rose between 20 to 30%, and also on the back of rising ocean freight prices, which have almost doubled, and rising container prices as well. So good sales, but going ahead, we can see price hikes, which could also translate to better sales. We don't know. We have to wait for the festive season performance also to see what the full year sales will be like for the industry.
Okay, all right. Thanks very much for that. So that's, on the entire consumer durable space. We'll take a short break, but on the other side, our commodities corner, Manisha Gupta will be joining in. Kunal Shah of Nirmal Bang Commodities will be with us. Stay tuned.
Welcome back, and joining us on the show now is Kunal Shah. He's head of commodities and currencies research at Nirmal Bang. Kunal, hi, good to have you. And, the month of June actually has seen quite a bit of a profit taking across commodities, whether it's agro and non-agro. The month of April and May were quite on the stronger side, but the markets are looking at strength in dollar and the expectation that after this very strong US non-farm payroll data, perhaps the US Fed rate cut may not happen in September, and that clearly seems to be weighing in. I want to start with precious metal prices because the bigger hits clearly have come in for this one. What is your sense on gold and silver prices from here?
I think we've seen correction in gold and silver on account of two things. One, in the month of May, for the first time after 18 months, China did not buy any gold. So they did not buy any gold because the prices have risen from $2,000 to $2,450. So almost there has been a rise of 12.5%, 13% in a matter of 3 months. So people are exaggerating that thing that China may not buy gold going forward the way they used to. But that's not the fact. All the BRICS economies, all the economies who wants to trade in their own currency with the other trading partners, they will need to buy more and more gold going forward. So I think this was a much needed correction after a humongous.
Well, yes, after hitting those all-time highs that we saw in gold and an all-time high in silver in the Indian markets, well, this is a much wanted, expected correction that we could see in gold and silver prices. But where do you see supports come in for both of these precious metals? All right, we'll try and get Kunal back there. But remember, we've seen big amount of profit taking coming in. For gold, the all-time high was 2450. We're trading below 2300 right now. And for the silver prices, the global market saw an 11-year highs at $32 an ounce. And from there on, we've seen heavy amount of profit taking come in for this one as well. So trading below 30 at this point. And silver prices have seen 4.5% of a decline in the previous week itself. Kunal, where do you see supports come in? I mean, as investors who are looking out to buy gold and silver, where do you see the bottom now getting created?
I think gold should take a support around 20.
Okay, we'll try and get him again. But as he was saying, there is correction that is happening in the prices here. For the longest time, it has been about the global central banks buying in case of gold. And within that as well, China has been a major buying, which has been buying gold for 18 straight months until the month of April. For the month of May, China has not bought any gold. So that is something that is bothering the sector on whether or not we will see stronger global central buying going forward as well. So in that sense, the month of June is going to be very important to see on how China has been buying. Having said that, even if there is not a direct central bank buying from China, the sovereign wealth funds have been buying gold. So directly or indirectly, China really seems to be buying in that precious metal there. Also, when you talk about the industrial commodities, well, it is about the US non-farm payroll data that came in much stronger than what the street was anticipating. And from a 70% probability of a rate cut for the month of September from the US Fed, well, that number has gone down to almost 50. And the markets do anticipate that the first rate cut that might happen now could be in the month of November, and that's bothering the industrial markets as well. So we are looking at profit taking across board onto this one. So after stellar months in April and the month of May, June has started on a weaker note, not just for energy, which is down, by the way, by 7% in this month, but a decline in precious metals. The industrial metals also are trading at multi-week lows. Copper, for example, is trading at a 1-month lows. You also have steel, which is trading at a 2-month lows now. Iron ore price is trading at a 5-week lows. So everywhere that you look, we are looking at pressure into those markets. And that's exactly what the street will watch out for now. It is going to be the CPI numbers and the US Fed meeting that starts tomorrow. And the announcement would come in on Wednesday. That would give you further direction for all those markets, by the way. But with that, that's a wrap on Halftime Report. When we return, Business Lunch will take all the action forward.